You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. Today we're going to talk about the federal debt, among other things. You know, the U.S. is navigating historic levels of debt, both in absolute terms and, more importantly, relative to GDP. And interest costs are really ballooning. Around $1 trillion a year in interest now limits our budget flexibility. It's the second biggest line item in the budget behind Social Security. And as more of these bonds come due, more of the treasuries, and refinancing has to be reissued with higher interest rates, fiscal and monetary policy decisions will face increasing market scrutiny. How does the U.S. get out of this debt cycle? What about the impact of tariffs that we're starting to see maybe a little bit of an inflationary impact? How's the Fed likely to react to all of this news and react to the data? Finally, how do you need to be adjusting your planning? How should you be investing amidst these market conditions? Today, our guest is David Wagner, a great friend of the show. He is portfolio manager and head of equities at Aptus Capital. David is responsible at Aptus for equity research, selection, evaluation of macro-level trends, and certainly advising with the current market environment. He's become a very good friend, as Aptus has, to Brogan Financial. They're a great resource with their team of financial analysts. Prior to joining Aptus, David worked with Opus Capital Management and Dry House Capital Management, where he was responsible for conducting research and analysis for small and micro cap equity strategy. He is a regular contributor on CNBC, Bloomberg, Fox Business, The Wall Street Journal, and Barron's. Good morning, David. Great to have you on.
Jim Brogan, thanks for having me, and I always love spending Sunday or Saturday mornings with you.
I love spending Saturday morning with you. Now, before we get to the market stuff, I've got to talk. You know, we know, those that have listened to the show over the years, you're a big Kentucky boy. You have an undergraduate and a graduate degree from Kentucky, right? You run blue. Are you very comfortable today about hosting the Ole Miss Rebels?
I would say Tennessee football fans are more comfortable with their game today than us Kentucky fans against the number 20 ranked Ole Miss. You know, well, we had a tough week last week. I think our quarterback, our grad transfer, he needs to show something. He couldn't get the ball downfield. But, you know, Jim, I do love our backfield. You know, we have a great dynamic duo at running back that I'm pretty excited about for the season.
Okay, well, that's good. Well, it'd be interesting to see it evolve. Now, David, you've spent your career focused on market research. You got your Chartered Financial Analyst certification designation at a very, very young age. When did you become interested in the stock market and the economy and decide that was what you wanted to do?
Yeah, Jim, I love this question, and it probably goes back to when I was in high school. You know, I was doing my college visits. And I would tell you, you know, I know you have a place down in South Carolina. I was looking at College of Charleston, a location just where your amazing daughter, Mary Caroline, was just married. I looked University or College of Charleston, but I also only looked at Kentucky. So I was in high school, and I went down with my sister to the University of Kentucky. And you know, usually during college visits, you go look at the campus, you look at buildings, you look at the dorms. Well, we decided that wasn't really our style. So my sister, some of our friends, we went to the best racetrack, best thoroughbred racetrack in the United States called Keeneland in the heart of Lexington, Kentucky. And, you know, there's a lot of similarities I came to find out between horse betting and the stock market, you know, due to the pari-mutuel betting system within horse racing, and then also recognizing the odds and valuation of the market and just trying to find, you know, what the winner's going to be, what stock or what horse is trading at the best valuation, have the best bang for the buck for some type of return. And, it kind of just blossomed from there, Jimmy B. I studied finance, accounting, masters of finance and CFA. And, I guess it all comes back to the heart of Kentucky, and that's Lexington, Kentucky, home of the University of Kentucky.
Yes, sir, and I've been to Keeneland one time and need to go more because it is an absolutely beautiful place. So I'll echo that. Let's dive in.
We do know who your favorite horse of all time, though, is Jim Brogan. At the heart of Claiborne Farms where you visited.
Yeah, Secretariat's definitely my favorite horse of all times, and we had our picture taken there together. That was great.
We did.
Let's talk about the debt. It's over $36 trillion now. How did we get here? Where are we going? How big of an issue is this, do you think?
I would say that the University of Kentucky Wildcats have a harder time. Will have a harder time today with Ole Miss than the U.S. government with the debt right now. And I do think that is a huge polarizing view out there in this market, Jim, especially when you have the U.S. debt now close to, I think it's like $37.3 trillion. I mean, to the point on your opening monologue, this is the highest absolute national debt that we've ever had. And I would say that when you watch media pundits on CNBC, Bloomberg, Fox, we all want to scare people with the overall absolute number. Though I think we need to look at it a little bit differently. We need to look at it on a relative level. You did make a great point that on a relative level, we do tend to skew to the higher end relative to history. And you used the amazing ratio of debt to GDP. And let's kind of walk through that. And right now, the debt to GDP here in the United States is about 120%, meaning that our overall debt is about 20% higher than our average annualized gross domestic product here in the U.S. That's basically just all the revenue that the U.S. puts together.
So, David, how does that compare historically?
Yeah. So obviously we peaked during the COVID timeframe. That was about 130%. And as our economies continue to grow, that number's come down to 120%, which is a good thing. But historically, if you look back over the last 50 years, we've probably ranged in the 60 to 70% range. So that's why I think there's so many elevated conversations in regards to the debt right now and how we're going to fix the problem. There was a lot of studies, Jim, done out of Japan on like what level of debt to GDP of that ratio does an economy need to start worrying about the debt? And everyone would always point to Japan. They're kind of the poster child of having a high debt to GDP ratio. And we'd always try to figure out when did that really start to spur the necessity of austerity in Japan, or, what could create the austerity in Washington, D.C. And they always said it was over 80%. So once we got above that 80% threshold, Americans, economists, analysts, we really started to focus on that debt because, quote unquote, that kind of got to the oh my God territory.
So it doesn't sound like you're quite as concerned is kind of what I'm hearing. You said Ole Miss, you said Kentucky will have a much, much harder time than our federal government will having this debt. I'm not completely sure how to take that, but let's say this. So there's different ways that we can attack that debt problem, right? I mean, it's not just one thing. Talk about several. I mean, there's 3 or 4 different things that could all contribute to helping get the debt down. One of those, of course, is economic growth. Can you just expand on that a little bit?
Yeah, Jim, I try to be more of a rational optimist when it comes to the market and life, because I do think that pessimism about the long term just does not align in any way with the historic worldview. I mean, investors can choose to believe that right now is the beginning of the end, but that is a bet against all of human history and against human nature itself. As always has been the case, progress occurs against an inevitable backdrop of catastrophe. We could probably say that out of COVID. It always has and always will be, but invariably you can always find what you go looking for in regards to information, and your investment results will probably mimic that worldview. And that's why I think when we speak about debt, Jim, there's 3 ways to beat that debt problem. It's going to be austerity, which means spending cuts, kind of what we're trying to figure out with DOGE. The second route you could do is grow your way out of it, and that's through economic productivity. And the final way, Jim, is to inflate your way out of it. And that, in a nutshell, is just a debasement of currency.
So, you touched on something with the challenges of the market, and it doesn't make sense to have a negative view. I'm looking at an interesting chart here, and it's showing the returns of the S&P 500 for the last 90 years in 30-year increments. 1935 to 1965, the S&P averaged 12.4%. Then from 65 to 95, it annualized at 10.6. From 95 to 2005, ending in August, 10.4%. And that last 30 years has included the dot-com bubble, the Asian financial crisis, Russia default, the dot-com burst, 9/11, Enron, the Iraqi war, the great financial crisis, the housing crash, the European debt crisis, the taper tantrum, Brexit, trade war, COVID, Russia-Ukraine, 9% inflation, Liberation Day. We could go on and on and on. That's a pretty interesting thing to read, that over that 30 years, the market has still done pretty well, which kind of plays into what you just said.
Yeah. In the words of Larry David from Curb Your Enthusiasm, that's pretty good. But at the core, like Jim, because I think, like you said, anyone can be pessimistic. There's always that wall of worry to climb where you want to become more negative, on the market. But I truly believe that the game within the market has evolved over time, and that's just kind of a fancy word to say that it's changed, just with the evolution of, increased monetary policy and fiscal policy. Monetary policy are just the mechanism at hand for the Fed to print money and control interest rates. And fiscal policy is basically everything that comes out of Washington, D.C. And whether you're Republican or Democrat, we've just continued to learn, at least on the fiscal side of things, that spending is not going to slow down whatsoever. And then on the monetary side of things, that the Fed's going to continue to backstop the economy to make sure that it's going to continue to increase. Because I think, Jim, Scott Bessent, the U.S. Secretary of Treasury under Donald Trump right now, he's an old hedge fund guy that Trump brought on into Washington, D.C. But back, I think it was in January, he had this really important quote that I think got really overlooked by many analysts and investors. But he legitimately, Jim, gave us the playbook on how to handle this new current market regime as we look out the windshield. Because we all know the historical data that you just mentioned there. But he said something that, we can grow both the economy and control the debt. What is important is that the economy grows faster than the debt. And Jim, right now, we're running a deficit of about $1.8 trillion. And if you compare that to GDP, because we're all doing relativity here against GDP, that's a deficit of 6%. So for us to beat this debt problem, that's Scott Bessent basically coming out saying, hey, if we're running a deficit growing at an annualized basis of 6%, that means we have to grow this market, this economy at a rate greater than 6%. And if we do that, we can overcome the debt problem. But if we don't grow this economy at a 6% clip, well, then debt could really very much be a problem. And that's why D.C. knows through fiscal policy, why the Fed knows through monetary policy, we need to do anything and everything we can to engineer growth through different policies to make sure we kind of hit that 6% threshold.
Now, we've talked about a lot of things in this first segment, folks. One of the things, I mentioned 30-year stock market returns. The reality is if you're near retirement or in retirement, you don't have 30 years to wait on the markets. So managing volatility is also very important. What are we looking at as we look out the windshield with the impact of things like tariffs, Federal Reserve policy? We're going to continue to visit with our good friend David Wagner with Aptus Capital. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living here on News Talk 98.7 WOKI. I'm your host, Jim Brogan. I do want to mention, this Tuesday night, the next two Tuesdays, my next class through University of Tennessee, Financial Survival for Retirement. It's a two-part class through their adult education, lifelong learning. We cover 7 main areas that I think you need to know about in order to be successful with your planning for retirement. It's again the next 2 Tuesdays, the 9th and the 16th. You can go to financialsurvivalforretirement.com to download a syllabus and to click to register. Again, that's financialsurvivalforretirement.com. Today we're visiting with David Wagner. He is head of equities for Aptus Capital. He's become a good friend of the show and also of our firm at Brogan Financial. And before we leave the federal debt, a couple more questions I want to ask David. One is the interest on the debt. The amount of our budget that goes to the interest on the debt, of course, as interest rates have risen, is becoming a little bit more of an issue. You've talked a little bit in the past. At what point does Wall Street start to apply pressure because of the interest on the debt? We have a lot of treasuries coming due this year that has to be refinanced at higher rates. Can you talk a little bit about that stress on our budget?
Yeah, Jim. Obviously, a lot of the problems within our debt started to get magnified back in 2021 and 2022 when interest rates started to creep up. From basically 2009 to 2021, we lived in this environment. It had an acronym called ZIRP. It stood for Zero Interest Rate Policy. So we could go out and get debt very cheap as consumers. The government could refinance their debt at very cheap interest rates. And it kind of let this cog of the wheel continue to grind higher from, an engineering growth perspective. But as we had to fight inflation over the past few years and the increase in debt, rates went higher. So as consumers and as government, the amount of interest expense that we'd have to pay for some type of loan went very much higher. And right now, the weighted average coupon, that's basically the interest rate on debt for the government, it stands about 3.6%. But to put that into context, the weighted average coupon or interest rate that we would pay as a country 5 years ago was closer to 1%. So the interest expense that we have to pay on our debt as a country has continued to increase. Right now, it accounts for almost 17.5% of our tax revenue. Let me say that again. Almost a fifth of our tax revenue goes to paying U.S. interest. And what we've learned historically, Jim, is that there tends to be a little bit more austerity in Washington, D.C. when that figure gets above 14%. Well, we're at 17.5% right now. And, Washington, D.C., they tried to have some type of austerity through Elon Musk's Doge program, but that appeared to not work. So it doesn't seem like we're getting the austerity that we need in D.C. given the current interest rate environment. And I think some of the other numbers that I would love to state, Jim, is that about 70% of our budget is static budget. It's like stuff that we know we have to pay, whether it's Medicaid, Medicare, Social Security, a defense bill. It's like a lot of spending and that we have, it simply cannot go away. But you made another great point, Jim. It's, we have so much debt that needs to get refinanced in the near future. In fact, over the next 1 year, 33%, 1/3 of the U.S. debt has to get refinanced. Over the next 3 years, 54% of our debt needs to get refinanced. So as you alluded, Jim, as this debt rolls off, we obviously need to issue more debt, but we've had higher interest rates over the last 2 or 3 years. So as we refinance this debt, the interest expense aspect is going to continue to increase in the near term.
David, you've talked about ways to impact the debt. You mentioned austerity. You've mentioned economic growth. You've mentioned inflation, which is what happened in the 50s, 60s, and 70s, actually, with our debt coming out of World War II. I'd be remiss to not talk about income taxes. Now, I know this gets more into the financial planning realm, which is, of course, what we do. But if we look at developed countries throughout the world, throughout world history, typically when we see debt to GDP at these kind of levels, we typically see increases in income taxes. So, there are arguments of what's the best way to raise tax revenue. Is it to raise income taxes, or is it to actually lower income taxes and spur economic growth? I don't want to go too far down that rabbit hole. The bottom line is historically when when debt has been high, taxes have gone up. That hasn't happened since 1986. How important do you think tax planning becomes in our financial planning?
Yeah, Jim, that's why your job, what you bring to the table for investors at Brogan Financial is so much more important than anything I could do on the investment side of things. I mean, I never want the tax tail of the dog wagging the investment dog, but at the end of the day, tax planning is the most important thing that anyone can do, and I'm not an expert at that. That's where you step in, Jim. That's where you add the most amount of value. So I love that you're interviewing me, but I should be interviewing you about everything on the tax side, because that is the side of importance. But you're exactly correct. Like, it's kind of a self-fulfilling prophecy, taxes are, because it's almost like the government wants the stock market to do really, really well, because they're going to increase the amount of tax revenue that they're going to have from a capital gains perspective. But, Jim, they've done a lot of studies out there in the market. This might have been a McKinsey study, and it kind of talked about, like, what is the equilibrium for the capital gains tax? Meaning, like, what is the ideal capital gains tax where the government can collect the maximum amount of revenue? Because if you go over that threshold, maybe people just don't sell their stock. Maybe people just don't sell their investments. So you actually see revenue come down. And they recognize, Jim, that the equilibrium level for capital gains, the ideal level, is about 28%. So it is a little bit higher than where we are now. I don't want to impose any more taxes on individuals or corporations by any means, but it is very funny, Jim. You're exactly correct. Like, it's a kind of a self-fulfilling prophecy. As the market tends to go higher, as the economy tends to do well, the government tends to collect more money. But, Jim, we all know what the government does when they collect more money, and we've seen it for the last infinity amount of years. They go out and spend it.
They do. You know, that's interesting. You talked about the optimal capital gains rate. You know, Art Laffer, former chief economic advisor to Ronald Reagan, he moved to Tennessee, the Laffer curve. So he argued that less taxes, he of course pioneered the Laffer curve, but he argued that less taxes would promote more revenue and would lead to therefore more tax revenue, even with lower tax rates. You know, he moved to the state of Tennessee. He lives here now, and he was able to successfully get the Tennessee inheritance tax repealed in the state of Tennessee because he felt like it would attract more people to the state of Tennessee, which ultimately would drive up more revenue for the state. Yet that's exactly what we've seen in Tennessee. Any comments on that? Because that's exactly what's happened here.
Are you trying to get me to move to Tennessee, Jimmy B? I know that's hard. I'm a Kentucky guy, but you're making a really, really great case. I mean, one of the best presidents of all time. Like under Ronald Reagan is where Art Lafferty was. Like, Ronald Reagan is one of my favorite quotes of all time that I've been using so much here recently, and it talks about economists. Like, all the listeners, like, Jim knows how much I dislike economists, but Ronald Reagan came out with the quote. He says, like, I want a one-armed economist. All right, because whenever you talk to an economist, they're like, well, here's what we think is going to happen, but on the other hand, this could also happen. Like, we need more conviction in this world. That's why we want the one-armed economist, and that's what Art had. So I love what he's done. I mean, think of all the business, whether it's in Knoxville, one of the most beautiful cities in the United States. Yes, I just said that on air as a Lexington guy, but even think all the way down to Nashville, Chattanooga. Like, he's done amazing things for the states.
Yes, he has. Tell you what. Have tariffs really made a meaningful impact on revenue? We know it has increased revenue. Can it actually help with the debt issue? And how are tariffs likely to affect inflationary trends and the Federal Reserve's likely reaction to that? So stay with us. We're visiting with David Wagner. He's head of equities with Aptus Capital. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living with Jim Brogan. where it's all about living the best years of your life your way. We're with you every Saturday here on News Talk 98.7 from 9 to 10 a.m. and again from 3 to 4 p.m. You can catch us online. We podcast at Apple Podcasts, Spotify. You can also go to my website at broganfinancial.com, click on radio, and you can stream our shows there. We'll have today's show up by Tuesday afternoon. We've got several years worth of archived radio shows on our website. Today we're visiting with David Wagner. He's head of equities for Aptus Capital, and we're talking about some of the challenges in today's marketplace, particularly the federal debt. Before we leave the debt, I just want to mention, David, the tariffs. Tariffs have increased revenue some. Do you think tariffs can have any true meaningful impact on our federal debt?
You know, Jim, if I had to give a binary answer there, I would say yes. I really think so. There's a lot of misconceptions about the tariffs out there in the market. You know, I just bashed on economists, and every economist said that they absolutely hate tariffs. But we've never really seen tariffs play out, especially in the environment that we live in right now. I mean, think back in the 1920s. Like, there's a huge misconception that if you were racing a bicycle in the Tour de France, like, they would smoke cigarettes beforehand because they thought it opened up their lungs. Like, we couldn't have found out that could have been more wrong. And I think that's kind of what we're learning with tariffs right now. Like, if you kind of break it down, like, tariffs from an inflation standpoint, it's not going to substantially increase inflation. Like, they've done a bunch of studies. A bunch of analysts have done studies on tariffs that, hey, you know what? It's a one-time price increase. It may increase inflation by 0.5%, maybe 0.75% for one year, and then everything will be just okay. So I think you can throw the inflation argument somewhat out the window because, you know, Jim, a lot of people have a misconception about inflation too, that we've only seen inflation peak up over the last few years. Like, the government has been debasing our currency every single year, really since the origination of the Fed. For some reason out there, they have us stating that a 2% inflation rate is a healthy inflation rate. You know what a healthy inflation rate, Jim, is? It's 0% to me, because if you're inflated at 2%, you're just losing your purchasing power of your hard-earned dollars by 2% every single year. But to go back onto tariffs, because that was partially a side rant there. I'm sorry for that, Jim. But
That's
when
okay.
it comes to tariffs, like, who's eating the tariffs? Because, you know, President Trump did come out and say, hey, China's going to pay for the tariffs. Well, what we've seen so far is that's not wholly true. There's going to be three parties that pay for tariffs. It's going to be foreign exporters, it's going to be U.S. corporations, and it's going to be the U.S. consumer. And originally, people said that the U.S. consumer is highly likely going to eat about 70% of the tariff costs, about 20% by U.S. corporations, and about the residual 10% by foreign exporters. But what we've seen so far, now that we're almost 6 months into the new tariff regime, it's almost like the opposite. The U.S. corporations are eating about 60% of the tariff costs, consumers about 30%, and foreign exporters about 10% right now. And right now, last thing I'll say, Jim, like, you know, if we were to continue to implement tariffs, I know it's going to the court system, it's probably going to go to the Supreme Court with the court ruling case at the end of next year, mid next year. It's like, there's no better time to try to figure out tariffs and roll them out than over the past few years, because the consumer remains very strong, corporations remain very, very strong. So in my opinion, you know, I do think tariffs could be beneficial to the U.S. debt, and there's no better time to kind of give this tariff playbook a try than right now.
Now, Federal Reserve Chairman Jerome Powell has said on the record he believes we'll see more of a one-time increase in prices, not an inflationary trend, just like what you just said. Before we leave this, because I really want to get into investing in today's marketplace, David, and really dive in with some actionable things people can take with them. Do you see the Fed cutting rates this month? There's a lot of speculation they'll cut 1/4 point. Talk about just briefly about the Fed's dual mandate and the challenges that they're seeing right now with employment, you know, with hiring jobs numbers being fairly weak right now, but also inflationary bumps likely.
Yeah, so the Fed's dual mandate, that simply just means, Jim, that, you know, the Fed wants to look at two things. Their dual mandate is let's try to be at full employment as long as we possibly can, and then keep inflation in check. And their focus has been more on inflation over the past few years rather than the labor market. But really, since Jackson Hole, it's kind of the once-a-year event that the Fed puts on, obviously in Jackson Hole, and it happened last month, and it feels like they're really starting to transition their focus from inflation to the labor market, because we do think that we are starting to see some cracks in the labor market. I don't think it's deteriorating by any chance, because you're still seeing average hourly earnings increase by 3.7% on a year-over-year basis. So I think their dual mandate is still somewhat in parity, but I think that we need to be cognizant of some of the increased risks that have arisen from tariffs or just from a slowing economy. And that's why the Fed is looking to cut rates. And with the non-farm payrolls that came out just yesterday, the one we saw last month, and some of the recent inflation data over the past month, we're likely going to have a cut in September, and we're also going to have a cut in December. At least that's what the market's pricing in. We're actually starting to price in a third cut by year-end in October. But as of right now, Jim, it doesn't look like we're going to try to do a 50 basis point cut in September. But it definitely seems that it's more of a precautionary cut right now, because the Fed is seeing slowing growth. And right now, rates are pretty high, to be quite honest, and they want to bring that back in, which could spur some more economic growth.
We're visiting with David Wagner. He is head of equities for Aptus Capital, as you're listening to More Living with Jim Brogan. David, let's talk about the markets right now. Let's talk about planning for the future. Let's really get into some meaty stuff here. First, let's talk about the S&P 500. Actually, before we get in the S&P 500, let's just talk about the overall U.S. stock market. Our U.S. stock, we're near we're at all-time highs, of course. Is the market overpriced? Talk about where U.S. stocks are priced today in your view.
Everyone, Jim, wants to say that this market is overpriced, and I vehemently disagree. But when you look at investor behavior, Jim, over longer periods of time, it's like when the market hits new all-time highs, it's actually like clients want to take risk off the table, that they want to become a little bit more conservative or a little more pessimistic because you're hitting all-time highs. And I think, empirical evidence really challenges that notion, because when you hit all-time highs in the market, on average, the next 12 months return for the market tends to be above average and at a lower standard of deviation, which means a lower volatility rate, that it's less volatile. So when investing at all-time highs, it's actually the best time to have your capital at work because of that fact. Better than average returns at lower volatility. And I just think that just really goes against common belief.
David, when we talk about valuations of stocks, people talk about PE ratios, price to earnings ratios. There's a lot of different ways to measure that. And there is a lot out there in the financial press about high PEs. I'm looking at a chart of the S&P 500. I think it's important for people to realize the S&P 500 is a weighted average index. So the larger the company is, the more impact it has on the movement of that index. And this chart, David, goes back a little over 20 years, and it's showing what percentage of the S&P 500 is weighted to technology. And it's the highest it's ever been. We're at 46%. So my question is measuring historic PE ratios in light of us being at all-time highs in terms of the technology impact on the S&P 500, is it even that relevant to look at historic PE ratios?
Yes and no, but it does give me a lot of excitement, Jim. I'm a big Kentucky fan. I'm a bigger American fan, and I would assume that's something we can agree on. We're big fans of America, Jim, and there's no other country that I'd want to live in or invest in is outside of the U.S. because of that exact fact. The technological innovation that we have here in the U.S., it compares to no one else, even relative to China, Taiwan, or anywhere else. And that's why I think this new valuation that we have, though it's higher than what we've seen historically, I think it's very much warranted. Because, if you look at Europe, it's very much a services-based economy. Lots of financial companies and a lot of service-based companies. If you look, more on the emerging markets like China, India, or Vietnam, anywhere on that side of the hemisphere, they tend to be more commodity-based off of metals and miners and value-added tech companies that really just could put semiconductor chips together. Not huge value add. Like the amount of intangible property, intellectual property that we bring here in the United States is compared to by no one. So I actually think the valuation we see here in the United States is actually very palatable for the amount of growth that we have, not just over the past few years, but looking out into the future. And I'd leave you with one stat here, Jim, before I turn it back to you is like, if you go back to 1984, okay, so it's almost 41 years ago. If you took all of the stocks in the S&P 500, so the 500 stocks in the S&P 500, and looked at their assets, 95% of the assets on the balance sheets of all of those 500 companies in aggregate was hard assets, was tangible assets. So think manufacturing equipment, trucks, buildings, plants, those tangible assets. Well, fast forward to today, if you do that same exercise, 99.9999% of the assets on all the 500 S&P 500 companies' balance sheets is intangible property. All right, so it's also said intellectual property. And that intellectual property gives us the ability to potentially grow faster through economies of scale through this newfound technology. What it was back in the 2000 years of the internet, founded in America, what we're seeing right now with this more evolutionary than revolutionary technology with artificial intelligence, founded in America. Like there's no other place I'd want to live, Jim. There's no other place I'd want to invest than in the U.S.
Yeah, and it kind of makes us think, does the market know with this change, it's almost a paradigm shift in what you just said in terms of the assets on these balance sheets of these S&P 500 companies. It makes you wonder, kind of back to my question on the PE ratios, how relevant are historic PE ratios? You said yes and no. But does the market really know how to price these companies based on their future earnings when we're seeing a paradigm shift like this? I just think that's very fascinating to think about.
Yeah.
Let's talk.
That's why there's probably so much volatility there. So go ahead.
I want to talk about managing volatility. I mentioned earlier, we're talking about 20, 30-year numbers. The reality is, as people age and get closer to retirement, they have to worry about shorter-term volatility. Of course, part of the financial plan should build in an allowance for short-term volatility because it's an inevitability of stock market investing. But from David's sense, I want to get into how should we manage market volatility in the short term to enhance returns in the long term, or should we even be doing that? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in to More Living this morning here on News Talk 98.7 WOKI. We've been visiting with David Wagner. He's head of equities at Aptus Capital. Aptus Capital, down in Fairhope, Alabama, is where they're headquartered. They do some great things, and they've been just a tremendous resource for Brogan Financial. They have a great team of financial analysts and really help firms like mine with investment research and a lot of great things. David has become a good friend over the years. So, David, I do want to, number one, I want to thank you for all that you do in the community, all that you do on the financial news and in helping educate people coming on this program. Let's dive into managing market volatility, particularly, let's be clear, downside volatility. We're fine with upside volatility. How important is it to manage downside volatility when we know volatility is just a reality of life in the stock market?
Yeah, first of all, Jim, we love our partnership here. I do think we're doing some pretty cool things out of L.A., and that's the real L.A. in the words of Bo Cephas, Lower Alabama, not Los Angeles. We pride ourselves not being kind of your 40L suit New York people, so love our partnership. But even though we're a firm based out of L.A., i.e. Lower Alabama, I do think that we're very pragmatic with our thinking, and we've evolved with the market, especially in tune to this conversation, Jim, about downside volatility. And volatility, Jim, it's normal, it's healthy, and it always occurs. For example, the market sees a 5% pullback on average 3 times a year. it sees a 20% pullback about every 5.5 years. At least that's what history has said. But I just said that a 20% pullback happens every 5.5 years on average. Well, we're 5.5 years into this decade of the 2020s, and we've already seen 3 pullbacks of 20% or greater. We had COVID, which was about 34%. 22 was about 24%. And this year, during the tariff debacle, the market pulled back 21.5%. But even though we're firm out of LA, I think we've seen kind of the writing on the wall that traditional ways of investing in the stock market, especially in regards to protecting capital and downside, like everyone will say, hey, I want to own more bonds if there's going to be more volatility. I want to own bonds if the market's going to go down. And I think that ideology needs to change in our minds.
Absolutely.
Because we've continued to see a positive correlation between stocks and bonds, meaning that when stocks go down, so do bonds. And so we need to be pragmatic on our thing. Like, what else can we be doing to make sure we protect capital on the downside? Because, Jim, you say this all the time, talks about the utilization theory about drawdowns. A 10% pullback in the market mentally hurts about 5 times more than a like-minded 10% increase in the market. But not only that, there's a bad math of drawdowns. If you go down 10%, you got to go up 11.1% to get back to even. If you want to be more crazy here, if you go down 50%, you have to go up 100% to get back to even. That's just math. There's bad math and drawdowns. And I think that you have to think outside the box and not rely on fixed income as kind of the ballast of support in a portfolio to protect capital. I think that there's new ways to do it. And Jim, you've been very on the forefront, you and your entire firm on, thinking of how can we think better? What can we do better? Because that's a question you always ask us, Jim. Is what can we do better? How can we evolve? And I think this is one of the first things that we fully agreed upon to create this partnership was that, hey, you know what? Bonds, they're not going to support on the downside. And I think we have to find new ways, which as a partnership we have done so by utilizing options-based ETFs that have a known correlation because they have a negative carry where they will protect on the downside. And that gives you the ability to actually own more stocks. Because, Jim, at the beginning of this radio show, we spoke about, hey, if we have this debt problem, the best way to attack the debt problem is to grow out of it and inflate out of it. And you know what the best asset class to own is in this debt situation, if you inflate your way out of it and grow your way out of it? It's stocks. So let's own as much stocks as we possibly can, but still protect capital on the downside through a lot of these new innovative ideas to protect on drawdowns.
Yeah, so it is. We do need to manage downside volatility. I couldn't agree more because of the cruel math. I like to call it the cruel math of those losses. You lose 33% to just kind of piggyback. You've got to make 50 to get back to where you are. Where when you get up over 30 and 35%, it can take a long time to recover those losses. And in retirement, we don't have that type of time on our side. Now, one of the things I just want to piggyback on there, David, is when we talk about bonds, historically bonds, they've been a drag on long-term performance, right? I mean, they haven't really beaten inflation over the long term if we look at U.S. Treasuries. And, we just have to be very careful. We do need to manage downside volatility, but I'll just echo, we want to do it. If anytime we can own more stocks and less bonds while maintaining the risk profile we want, that's also always going to be a good thing, right? Because then we're going to have more earnings potential over time.
It's the best thing because, as I mentioned about inflation always running at 2%, that's the goal of the government. That just means that your dollar's worth less 1 year from now by 2%. And the only way to attack this purchasing power decline, because that's what it is to own more risk assets. And I think that's the biggest problem, the biggest risk I see out there with many advisors, not just across Kentucky or Tennessee. It's across the entire United States, just an over-reliance on fixed income.
Yeah, so we need a diversification to manage downside volatility. We need more diversification than just traditional bonds. We're not saying, I'm not saying you don't need any traditional bond exposure, but you just have to be very, very cautious with that. David, here we only have about 20 or 30 seconds. What do you see for the economy as we head into the fourth quarter?
I think the next month or two could be slightly weak. I'm not saying that it's going to go down. There's a lot of liquidity coming out of the market, but heading into the end of the year and over the next few years, I'm very optimistic. Just about as optimistic as the Cincinnati Bengals winning a Super Bowl this year. And I'm optimistic there.
That's great. I'll just say markets are volatile in the short term, so short-term income, we need to have stable, safe assets that we leverage for short-term income for next year, 2 years, 3 years from now. David Wagner, thank you so much, Tom, for taking time out of your schedule. You're such an encyclopedia. Thanks for sharing your insight.
God bless, Jimmy B.
God bless you. That's David Wagner, Aptus Capital. Today we've discussed the markets, the federal debt, the future. We've discussed your wealth, because greater wealth provides for more living so you can live the best years of your life your way. Have a very blessed weekend. You've been listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.